Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of why the Dodd-Frank Act matters to your investments. Reduced proprietary trading. Thanks to the Volcker rule, banks had to wind down high-risk, high-reward trading operations. This shift has led to a focus on more traditional customer-facing services, higher capital requirements. To prepare for potential losses, banks are required to keep more money in reserve. This helps reduce the likelihood of them collapsing during an economic downturn. While these changes have made the financial system safer, some argue they've also slowed innovation in banking. Are these trade-offs worth it? That largely depends on your perspective, but most agree the reforms have reduced the systemic risks that led to the 2008 crash. Economic stability and growth. One of the biggest promises of the Dodd-Frank Act was greater financial stability. But how has it played out in practice? On one hand, the Act has been incredibly effective at building a sturdier economic foundation. Fewer bank failures, the requirement for higher capital reserves and better risk management has made banks less likely to fail, even during economic stress. Consumer confidence. With measures like the Consumer Financial Protection Bureau, CFPB, ensuring fair treatment, consumers now feel more secure using financial services. Reduced systemic risk. By regulating derivatives and creating oversight structures for large institutions, the Act has lessened the chances of another widespread financial meltdown. Yet the Act hasn't been without criticism. Some argue it has curbed economic growth in certain areas. Slower lending to small businesses. Stricter lending criteria mean some small businesses struggle to secure loans, potentially stalling growth and innovation. Increased compliance costs for smaller banks. While large banks can absorb these costs, smaller community banks often feel the strain, leading to fewer local lending options. Lower risk appetite. Banks have become more cautious in their investments, which, in some cases, can limit broader economic expansion. Despite these critiques, the consensus is that the Dodd-Frank Act created a more stable and secure financial system. It's like installing airbags in a car. Not everyone loves the changes, but when disaster strikes, you're glad they're there. Criticism and controversies. Dodd-Frank was designed to fix problems exposed by the 2008 crisis, but it hasn't escaped criticism. While its goal was to create a safer financial system, many argue it came with unintended consequences. Critics have questioned whether the benefits outweigh the drawbacks, especially when it comes to economic growth and effectiveness. Claim of over-regulation. Arguments that the Act stifles economic growth. Some critics claim that Dodd-Frank's strict rules hurt the economy. They argue that while the Act aimed to rein in risky practices, it also imposed heavy burdens on businesses, especially smaller institutions. Increased compliance costs. The Act introduced new rules that require banks to spend more on compliance staff, reporting systems, and audits. While larger banks can absorb these costs, smaller community banks often can't. This leaves them with fewer resources to lend or grow. Stricter lending standards. Dodd-Frank forced banks to tighten their lending practices to avoid risky loans. While this reduced bad lending, it also made it harder for small businesses and individuals to secure credit. Fewer loans mean fewer opportunities for growth in sectors that depend on accessible financing. Discouraged risk-taking. Critics argue that the Act's restrictions discourage risk-taking, which is essential for innovation and expansion. If banks are too cautious, they may miss out on potential growth opportunities that could benefit the economy. Think of it like adding too many safety belts to a car. Sure, it's safer, but what happens if the driver can't move freely enough to drive efficiently? Critics suggest that a balance between safety and flexibility might better support economic growth. Inadequacies and loopholes. identifying shortcomings in the Act. While Dodd-Frank aimed for comprehensive reform, it's not perfect. Over time, analysts have pointed out gaps and weaknesses that have allowed some institutions to maneuver around its rules. Too big to fail still exists. One of the Act's main promises was to eliminate the threat of financial institutions being too big to fail. Yet critics argue that the largest banks have only grown larger since 2008. The concentration of power in a handful of massive institutions suggests the risk of systemic failure persists. Shadow banking loopholes. Shadow banking, financial activities conducted outside traditional banks, operates in a grey area. Some argue these institutions have exploited gaps in Dodd-Frank's oversight. For example, hedge funds and private equity firms often don't face the same scrutiny as major banks, even though they can pose similar risks. Complex derivatives still thrive. Although the Act introduced regulations on derivatives, certain complex financial instruments remain under-regulated. Sophisticated traders sometimes find ways to use these products to sidestep accountability or oversight, creating new vulnerabilities in the financial system. Slow implementation. Many of Dodd-Frank's provisions took years to fully implement, leaving time for lobbying and dilution of its original intent. For instance, certain rules around proprietary trading and executive pay have faced pushback or delays, weakening their impact. The Act has been compared to a wide safety net, effective in some areas but frayed in others. Without constant updates and enforcement, its protections may fail when they're needed most. Recent developments and revisions. Since its passage in 2010, the Dodd-Frank Act has faced adjustments and challenges reflective of evolving economic and political priorities. Amendments to the law have softened some of its provisions, while ongoing debates suggest more changes could follow. To understand these developments, let's break them down. 2018 Economic Growth, Regulatory Relief and Consumer Protection Act. In 2018, the Economic Growth, Regulatory Relief and Consumer Protection Act brought significant changes to Dodd-Frank. This legislation aimed to ease restrictions on smaller banks while maintaining key safeguards for larger institutions. Here are some of the standout changes. Increased systemically important threshold. The threshold for banks to be classified as systemically important was raised from $50 billion to $250 billion in assets. For smaller banks, this meant fewer stress tests and reduced regulatory scrutiny. Relief for community banks. Smaller community banks faced fewer compliance requirements under the updated rules. For instance, they were no longer subject to the same capital risk standards as larger institutions. Mortgage lending adjustments. The law introduced looser restrictions on mortgage lending for smaller lenders, making it easier for community banks to issue loans without adhering to all Dodd-Frank requirements. Tailored regulation. Mid-sized institutions gained relief from some reporting and oversight obligations, allowing a more customized approach to regulation based on their size and complexity. Proponents argued these changes were necessary to allow smaller banks to thrive without bearing the same burdens as Wall Street giants. Critics, however, worried that relaxing these rules might reintroduce some risks the original Act sought to prevent. Ongoing legislative and regulatory changes. The conversation around financial regulation is far from settled. Policymakers, regulators, and industry leaders continue to assess how the Dodd-Frank framework can meet today's challenges. Key areas of focus include revisiting systemic risk regulations. While the 2018 changes reduced regulatory burdens for mid-sized banks, some argue that this has left gaps in oversight. Recent bank failures have reignited calls to lower the systemically important threshold back to $50 billion. Climate risk in financial practices. Regulators are looking into how climate-related risks could impact financial stability. Proposals include requiring banks to disclose their exposure to environmental risks and preparing for potential economic disruptions tied to climate change, digital assets, and cryptocurrency. Oversight. With the rise of cryptocurrencies and blockchain technology, calls for clearer rules around digital assets are growing louder. Lawmakers are exploring how these markets should fit into the existing regulatory framework to prevent fraud and promote stability. Consumer protections and fair lending. Some regulators are considering updates to strengthen protections for borrowers, particularly in underserved communities. This could involve tightening rules on payday lending and ensuring fair access to credit. Pushback against deregulation. Advocates for stronger regulations continue to argue that rolling back provisions of Dodd-Frank might create new vulnerabilities. Financial watchdogs are pushing for stricter enforcement of existing rules, especially around large institutions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.